Hi, welcome to Conquering Your Financial Future with Your Wealth Hub. My name's Gavin Glozier, I'm the co-founder and director, and I'm here today with Phil Allen from My Debt Advisor. Welcome, Phil.
Welcome, Gavin. How are you?
Yeah, very well, thanks. Thanks for coming in today. We're here today myth busting and kind of overcoming people's, I suppose, misconceptions when it comes around getting a loan or dealing with the banks. Your world is all about specialising in finance, and one of the things that we continuously hear is how difficult it can be to getting a loan and kind of working with banks and all those types of things. Given your history, we want to try to kind of draw out as much information so our listeners can take as much as they can away from it. But I thought I'd open up with a relatively easy question, and something we get asked an awful lot about, and that's around savings. And when people are saving for a deposit or saving for a home, what are banks really expecting for us to save these days? What do they want when they're actually passing out debt?
Yeah, look, the first thing is to understand that all lenders have a very high duty of care. So lending is covered under consumer law. So they're not just doing, the things they do are not being done just to be mean, but they're really to make sure that you're not getting yourself in too much trouble.
When you say being mean, are you saying that people think banks can be mean?
Well, of course, why they're saying no, I'm going to be good for the money, but at the end of the day, they're held to a very high standard, and it's when things go wrong, in particular, they need to make sure that they've complied with what the government requires of them in terms of stopping people from taking too much risk.
And then getting themselves into a pickle because they're taking on too much debt.
Yeah. So that's the biggest thing. Obviously the main thing is there will be a property there to help secure the loan. So the major thing that they first look at is ideally they want you to have saved up to 20% of the property value plus the costs. So if you're lucky enough that you, depending on which state and things you live in, whether you're going to get the first homeowners grant and maybe an exemption from the stamp duty, then you might only need to think about the actual amount that you're saving to put into the property. However, depending on where you are and what you are buying, in a lot of cases you need to understand there's extra costs you need to show you can cover as well.
Okay. We'll talk about the extra costs in a moment, but I think in terms of people understanding what they need, 20% is a good round figure. However, in this day and age, it's not
always realistic to be chasing that for a long time. Yeah. And that was the next thing I was going to say. So if you have less than 20% deposit, then to a fair degree, the risk that the lender is taking giving you the money goes up. So from that point of view, they get a little bit careful again. And what they then want to do is very carefully scrutinise your savings. So you need to show that the same way if you had a mortgage, you would have to have the discipline to pay that every month. They actually look at what discipline have you been able to show in just regularly saving to get at least 5% of the value of deposit together.
And I assume that shows some kind of commitment to a spending pattern.
Yes, absolutely. So they will also look at things like, well, when you were saving, were you also paying rent? Because rent is very regular as well. But they've had a lot of problems in the past where people just get given 5 or 10% of the money.
Yep. And
then because they don't have any discipline and it's not something that they were really probably ready for, they're the loans that they've had massive problems with. So this is actually pretty much almost non-negotiable now that you have to have shown some discipline in saving, in showing you have been able to save at least 5% of the property.
So it's all about your run rate. It's all about showing that you're able to repay the bank. If they're happy with how you've been able to demonstrate that, they're more than likely going to be able to give you the money.
Yeah, and it's not like you're out with your mates on Saturday and you go, I'm a bit short, can I not pay till next week?
Yep.
So, if you've shown, think about it from their point of view, that if you were going to be giving your money to someone, what behaviours would you want to see?
Absolutely.
We've all got the mate or whatever, so the friend who, regularly borrows money and then you wait months and months for it to come back and you've got to ask for it, But then you've got other people who, if they're genuinely short $10, you give it to them in a heartbeat and the next day you've got it back.
Okay. Makes a lot of sense.
So really most of it comes down to common sense, and even though we've all had periods of life when this might not have been your priority and you haven't thought about it, that's why really you only have to start the habits and disciplines and show that generally for 3 to 6 months, and that's enough for them to show that's a habit you've started and been able to maintain.
Makes a lot of sense. So I've saved my 20%, but when it comes down to dealing with buying your first home or buying a property, it's not really 20% though, isn't it? There's going to be other costs that are going to be incurred. And if I actually, and I know you mentioned previously that if I actually fall under the 20%, if I don't have that, there's extra costs that are actually associated with getting my first property, is that right?
Yeah, so that's correct. But from that point of view, if you don't have a 20% deposit, then the lender is required to do what's called take out a special insurance policy on the loan, and that's what's called lender's mortgage insurance, LMI. So when you're talking to or you're reading material on it, you may hear about this lender's mortgage insurance, and what that is that because there is that real risk that you don't have a lot of equity in your property, the bank is required to go to an insurer and actually insure for any money they might lose.
Yeah.
If something goes wrong and they're forced to sell a property and they actually don't get enough back to pay the mortgage off in full.
So does that LMI give them the shortfall of what's actually kind of like reclaimed in a fire sale, or is it the whole amount? What's the bank insurance?
It's the shortfall. So
the shortfall. Okay.
The issue is, it is a one-off cost which gets passed on to you.
Yeah.
So in a lot of cases it can be added on top of the loan, but it does leave you with less equity in the property even from the start.
Yep.
But you need to understand as well that even in that case, the insurer will then come and ask you for the shortfall. You don't just get to walk away. Look, but that's a worst case scenario. So the only other way to, obviously, the closer you get, or the less deposit you have, the more the loan is as the total of the property, and that's exponentially riskier, and that means that accordingly the insurance premium gets exponentially higher.
Yep.
So it tends to work in single percentiles, but for example, if you've only got the minimum 5% deposit, you can get a property, but the mortgage insurance will likely be
really
very
high.
expensive.
Yeah.
Even getting to 90%, so having a 10% deposit, will substantially reduce it.
Yeah.
Because it's not that often a property sells for
Yeah.
to 10% less than what it's worth.
So the key is to try to aim for that 20% where you can.
Yeah.
To avoid the lender's mortgage insurance, LMI. But then after that, you've got things like stamp duty, you're going to have legal costs and things like that. For New South Wales, for instance, it's still 5%. And there's a scaled component, I think, as well.
Yeah.
So after 500,000 or 600,000, where you get a bit of relief.
Yep. So it's very important from that point of view to take the time to look at the price range that you are looking in, and just be aware of. So most states and territories have a really good website. So if you Google mortgage stamp duty or property stamp duty in your state, you'll get directed to the local website. And that's it's very important to understand, because with property prices being different, sometimes it's understanding that, well, if you go above that point, suddenly you are going to have to pay that instead of maybe being exempt.
Yep.
So it can make a difference in you. It's good to be aware of that when you're looking at a property and making an offer,
Sure.
where those benefits start to cut out and you're going to suddenly have extra costs you might not have factored in,
Yep.
but you've already signed on the dotted line.
Which is going to make things
Yeah.
difficult. Okay. Very good. Well, tell us, in kind of from your perspective, what's the easiest way you think you need to? What's the easiest way to beat the banks at their game? Like they're all playing games.
Yeah.
They all want their dollar.
Yeah.
We hear things like, there's no such thing as loyalty from banks anymore. You may be with them for years, but they'll still charge you like a wounded bull to get what they need to satisfy shareholders. So, what's your tips?
Absolutely. So, and I don't think it's going to come as a surprise to everybody that really you're just a number to the bank now. There's a few cases where being a client for a while at all can help you very marginally, but it doesn't get you a better deal. It doesn't get you special treatment. When you get on the phone with them, they don't call you by name and know you. You're just being looked up on a computer. You just really a series of numbers, and they don't care too much beyond that.
So those phone calls I get from the bank when they ring me up and say, Mr. Gavin, they're not personalised phone calls? No. Oh, okay. Right.
So the key thing to remember here is that a lot of the offers really are quite good, but they know that intrinsically we tend to be a little bit lazy.
Yeah.
And so keeping that in mind, though, with just a little bit of discipline, you can actually get quite a lot of value out of your mortgage into your bank. That's something we can look at. So one of the strongest things which I really recommend is you've got to be willing to do all the little things that just minimise your costs, and therefore that's not money that gets passed on to the bank. So there's a couple of those things. The first one is if you're taking out a new mortgage, make sure that you get the package you're being offered. Ideally, you should have an offset account.
I always look for an offset account.
Yeah. So that is just a normal transaction account that you'll pay and all your money can go into.
Yeah.
But any money in that account is treated every night when they calculate the interest is treated as paid off the loan. So if you have $479 in there, then that is treated as paid off the loan.
Yep.
So that basically means you are minimising your interest every single night.
And you also get, given it's an offset account, you're also able to draw back on that as well if you need to.
Yeah, it's a normal account. So it basically just, which is why the day your pay goes in, it's all being treated as paid off your loan, but you can just go to an ATM or you can pay for things totally as normal.
And given all your pays in there, that means that's a big chunk every week that's going to be taken off. And interest is calculated daily.
Yeah.
So therefore,
it adds up.
On that day, it's
over 25, 30 years, it's shown to really add up.
Okay.
If you're in an older loan or something that doesn't have an offset account, then that's when you get back that, if you can, pay as the minimum, so pay weekly if you can.
Pay weekly.
Instead of fortnightly, instead of monthly. So, because obviously they're calculating the interest every night. So, if you pay weekly, then that interest is being paid off rather than it continuing to, paying interest on the interest.
Yep.
And again, it's not a lot, but when you actually add it up over 25, 30 years, it starts to become quite a big number. It has a big compound effect.
Okay, great. So there's two great tips there.
The other big thing is that most of the modern loan products are very much, so what you'll do is you'll typically get your offset account for you to be able to, and you can often have more than one, so you might have your savings separately, but it can also be minimising the interest on your loan. So that could be your safety money, or your holiday savings.
Multiple accounts for budgeting, for instance.
So you can again, yes, keep your day-to-day money in a separate account, but so you don't overspend and fritter it away, you can then have the bulk of it sitting in a separate offset account.
Yeah, great.
But all linked to your loan, minimising your interest.
Yeah, great.
The other main thing is most of the better products now also come with a credit card as part of your annual package that will give you a 55-day interest-free period and reward points at no extra cost.
Okay.
So, if you use that wisely, use wisely from our experience. You can actually get one of their better cards that might normally itself have, say, a $200 annual fee.
Yep.
But just by putting all your normal expenses through it, as long as there's not a surcharge, there's no point paying a fee because that's like paying interest anyway.
Yep.
But normally, like Woolies and Coles and your normal petrol stations and stuff like that, you can use your card and there's no extra cost. But quite often, there's two things. The points can easily be worth $1,000 or more a year.
Yep.
So you're extracting a lot of value out of your bank that way.
Yeah, great.
And if you don't use it, it's built into everything, so you're missing out.
Okay, that's a really good one. I really like that. The 55 days interest free.
Yes. So people go, I don't want to pay an annual fee but if you, depending on your circumstances, paying the annual fee for your mortgage package, but then getting $1,000 worth of value out of the credit card attached to it, you're still well ahead. So the second thing as well, though, is again, it's about just having that little bit of discipline where if you're, by using the card, then you're using their money for the whole month and you're not paying any interest.
Yep.
At the same time, your money is sitting in your offset account, saving you interest on your home and after-tax interest on your loan. So the trick is what they rely on you is getting lazy though and not paying your credit card off.
Yep.
But if you just get into that discipline, or in most cases you can even set it up to do it automatically,
Yep.
just that once a month from your offset account, you just pay the credit card off in full.
Yep.
So you've paid no interest on the credit card,
Yep.
you've got all the points,
Yep.
and that extra money was sitting in your offset, saving you interest on your mortgage for the bulk of the month.
Okay, that's great. Let's move on to the next question, and our last question that we'll cover off. We're talking about debt history, and for people who have bad debt history or may have defaulted years gone by, does that basically rule them out of ever getting a loan again? Is there a time frame where they should be waiting? How can they redeem themselves from that?
Look, it's really, this is one of the things where if it's a good idea if you're starting to organise get for a mortgage, you can actually get a copy of your credit record for free.
Yeah.
So the first thing is to talk to someone you know or Google it, and there's a couple of mechanisms whereby you can get a copy of your own credit record for free.
And that covers off all your different types of
Yes.
debt. So from your credit card, your spending habits, maybe with
Telephones, you name it. But
Home
so
loan, yep, perfect.
the first thing that does is also to make sure there's no surprises on there.
Yep.
And the classic one is where you lived in a group house 3 years ago and you thought someone paid the phone bill and they didn't, and your name was on the phone as well.
Yeah.
So having said that, if it's a small bill like that, they generally don't have a problem.
Yep.
But they do like to see that it was, well, in most cases they like to see that it was eventually paid.
Yeah.
So in some cases where if you see on your credit record there's something there, you might need to phone up and unfortunately negotiate paying that bill. Having said that, up to about $1,000, most of them will look past it.
Yep.
The other thing to understand about your credit record is things only stay on there for a period of, I believe it's 5 years. So if it was more than 5 years ago, or it was 4.5 years ago, then it will then basically disappear.
Okay.
And then a lender, or because you're obviously seen to then have had good behaviour for that last 5 years,
Sure.
and lenders and everyone then aren't worried beyond that point. So
So
it won't even show up.
So even back to the first point we talked about when we're looking at good behaviours and good spending habits, albeit you may have had a bad record,
Yes.
but if you haven't had a new record for the past 5 years, that's also
Yeah.
triggered, or seen as a good thing.
Yes, that's right. You need to clean up your act. But the reality is, though, if you did have a dispute with someone and you decided that you just weren't going to pay it out of principle, and that has left a larger mark on your record
Yeah.
in some way, or it can't be easily explained, then that will cause you a lot of problems.
Sure.
So there's two things where this can happen. One of them, where it was quite unfair,
Yeah.
is there's very strict rules about how they can or cannot put something on your credit record.
Yeah.
And to be honest, a large part of the time they haven't followed the right rules.
Yep.
But you may need to engage. There's a number of good services out there who will then, it'll probably cost you a few $100s, but they will help get that off your record.
Yeah.
Because those kind of marks, if they are on your record, you basically won't get a loan from a normal lender.
Sure. Okay.
There are some lenders who will still lend to people with that, but it's at a much higher rate.
Yep.
It's far better just to make sure you've either got a clean record,
Yep.
or if there was a genuine reason and responsibility to go back and clean it up.
So when you talk about having the loan that you need or getting the debt refinance that you need, a higher rate means basically you're going to pay more money.
Yes.
And
So
that's,
it comes
that's
with,
a disadvantage.
And if it's something on your credit record, it's quite a big jump. So you're typically talking 1 or even 2% higher than you would get if you had a clean record.
Yeah, so on $100,000 of lending, that's $1,000 or $2,000 extra you're going to be repaying per year.
Yeah, and then so even on and obviously most people don't have a loan that small. So yeah, that's right. Even on a small 300 grand loan, it's now suddenly $3,000, $4,000, $5,000, $6,000 extra per
Starts
year.
adding up. Okay.
Just in interest.
Just
so that's not
interest,
paying the loan down. It's just throwing the money away.
Yeah, and that's not what we want. That's not
Yeah.
that's bad debt as opposed
Yeah.
to good debt.
So particularly if it's when you're looking to get organised for your first loan, that is why I really recommend get a copy of your own credit file.
Get a credit score.
Yeah, have a look at what's on there, and just check there's no surprises. And if there is, deal with them.
Okay.
It's worth investing a couple of $100 to get somebody to help you look into it and see if it can be taken off.
Great. Well, Phil, thanks for coming in today. There's some great tips. The big one I got was one of the first points you made around Googling from a state level to understand what your local stamp duty, so you understand the charges before you're going to buy a house. Last thing you want to do is be at an auction, putting in your best bid and realising, oops, I'm 50 grand out of pocket here because I'm well short after expenses.
Yeah, well, you actually can lose your whole savings. If you can't then complete that sale, they get to keep your deposit,
So,
and you're right back. It's a horrible situation.
Yeah, not good at all. So definitely Google where you need to be, understand how much your total charges are. In terms of ways to minimise costs, and make sure you're trying to structure a loan that has an offset account. Make sure you can change the frequency of which you're paying your loan. If you've got the offset account, that'll work hand in hand, so that's a little bit different, but that's a really good tip as well. If you can't get an offset account, look for your credit cards that have 55 days interest free or have rewards that are attached to it, so you can obviously earn and spend and also earn at the same time. From a credit perspective, I like the idea of checking your credit score and getting that straight up so you can see if you've got any surprises that may prohibit you from getting any finance. And as you said, they tend to disappear after 5 years, but that's showing you've got the right behaviours in place. So that's really good advice. Phil, thanks for coming in today.
Yeah. If there's one last thing I can add, the reality is that there are so many pieces involved in this, and while you can do a lot of your own research, you don't know what you don't know. It is very hard to pick up a lot of these pieces that are involved and the complexity of what's going on. It is well worth taking the time to speak to a good quality broker who has your vested interest at heart. If you just go into one bank or one lender, they're only going to tell you what they can do, not if somebody can do better.
So get a second opinion, shop around, see what you can do.
So generally with that, someone will give you a lot of extra information very specific to your circumstances, and generally that's basically no charge.
Yeah.
So, but the trick is via recommendation. You need to talk to somebody though who is good at what they do.
Great advice indeed. Phil, thanks for coming on. Phil's from My Dad Advisor. Thanks for tuning into our podcast, and we will see you again in the next couple of weeks. Thanks again for listening. Cheers.